Our next guest expects earnings growth to continue and sees opportunity in the Canadian markets. Let's bring in Philip Peturson. He is the Chief Investment Strategist, at IG Wealth Management. And right now, first of all, thanks for joining us, Philip. We appreciate it. And let's talk a little bit about where you're looking right now. You say you're overweight in equities and comfortable with that.
We are, and we're adding to equities, actually, and the volatility that we're seeing right now, if it persists, it's actually a good thing. It does give investors an opportunity to step back into the markets, many of which that perhaps missed that door opening in April and have been waiting for the next shoe to drop, and that shoe hasn't materialized. So when we look forward over the course of the next 12 months, we see the earnings growth that we've had last quarter, and judging by the banks, it's going to extend itself into this quarter. We think that can extend through at least the first half of 2026. So we're actually more optimistic on the economy and the markets going into 2026 than some of the sentiment surveys otherwise might suggest.
And what do you feel is driving the Canadian equities? What makes it so appealing? Well,
so far this year it's been gold. But it hasn't just been gold. And I think that is actually the appeal to the Canadian market. While gold has been the dominant driver of the materials sector, you've seen participation in the energy sector, financials, as well as consumer discretionary. So here too, we think that the Canadian market, which is more levered to the global environment, not necessarily the Canadian economy itself, is positioned to continue to do well. Gold might not see another run of 50%. In fact, I think it's less likely. But can we see it up another 10%? I think that's realistic. Energy, that while it's down, I think going into 2026 could see itself catch a bid, and we could see oil prices move higher. At the very least, natural gas prices, I think, will move higher on higher demand for electricity, both in Canada as well as the United States.
Any surprises you can see coming down the pipe?
Well, lots of surprises.
That'd be a surprise, but anything that you're keeping an eye on?
Well, yes. I would say, what's the risk to the downside? And we always think about that. You can't just sit there and say, oh, it's all great, just buy equities. It's like, what if we're wrong, and how do we position for that? And what we're watching right now is the labor market in the United States. We're not overly concerned with it. What we have right now is almost like a no-no labor market, no hiring, no firing. But if we go forward and we start to see layoffs pick up or the hiring really slow down, that could be a concern for the U.S. economy. But right now, that's not the case. While the BLS is not releasing anything, given the shutdown, we are looking at ADP. We're looking at
seeing other numbers.
Exactly. And the other numbers aren't distressing. It's saying, yes, the labor market has slowed down, but we're okay. And that's more of a residual of coming into 2025 with the uncertainty around the tariffs. I think that can reverse itself as we're starting to see manufacturing, and we think housing in the United States start to pick up.
Okay, and does U.S. equities have the same appeal as Canada?
Well, on the earnings side, yes, but on the weighting, we're actually positioning to an overweight Canada, international, and emerging markets, and we're neutral U.S. The reason we're neutral the U.S. is you can't ignore the valuation. Valuation, we could call it stretched, but certainly it's full. In some areas, maybe extended. And when you look on a relative basis, the U.S. versus Canada versus international, the earnings outlook actually isn't that dissimilar, but the valuation outlook is quite different. And so here's where international holds certain appeal, which is why it's perhaps outperformed so far this year, and we think can continue. If earnings hold up, you're getting the same type of earnings as you are in the U.S. for a much cheaper valuation on the stock level.
In the U.S., there's always risk in the U.S. market, isn't it? More than anywhere, it feels like.
Well, there is, the
but
question,
rewards as well, right?
Exactly. And the question that we've been hearing over the last number of months is, are we in an AI bubble? And maybe we are, but what stage of that are we there? We know at the end of the day, there's only going to be one AI winner, and everyone's throwing money into this. So there will be some losers along the way, but there are also going to be some beneficiaries underneath that will benefit from AI, whether it's our business in asset management and financial planning, or it's you're a manufacturer and you can use AI to improve your supply chain. There are going to be winners across the board. So it's not necessarily those rushing into AI that would lead to perhaps some hesitation given valuation, given the amount of money that's going into this area. But ultimately, it comes down to valuation, where can you get the same quality of earnings elsewhere for a cheaper value? Yes, maybe we lean into that.
Okay. And what about bank cuts, bank rate cuts, both U.S. and Canada? What kind of an impact might they have on all this?
Well, that's great for valuation. When you see interest rates come down, that supports higher valuation, whether it's in Canada or the US. But I think if we get down to the sector level, it's good for the banks. We've had the banks in the US report some pretty strong earnings this morning, and I think that's going to continue as we get a steeper yield curve, meaning the Bank of Canada is going to cut, the Federal Reserve is going to cut, but the long end might stay anchored. That steeper yield curve translates into higher profitability for bank loans. And ultimately better earnings for the banks longer term. So we do see more cuts out of the Bank of Canada. We see continued cuts by the Fed. That's a positive, not a negative.
Okay, and last one, we're almost out of time, but the tariffs and the wild card with China and the U.S., with that war going on, is Canada going to be caught in the middle, or can we benefit from it, do you think?
I think we can benefit if we navigate around that argument. I mean, this seems like a completely dysfunctional, codependent relationship between the two. And you never know exactly what's going to happen. But ultimately, I think we've got a situation in Canada that this has been good. This is a wake-up call for us going forward.
Okay. Philip, thank you very much for coming in. We appreciate it.
Thank you.
Philip Peturson is the Chief Investment Strategist for IG Wealth.